Welcome to Market AM Sentiment. Let's dive right in today. Have you ever felt like the market is speaking, I don't know, two different languages? One part seems to be soaring, right?
Yeah.
The other,
Well, it's troubling.
it really does feel like that sometimes.
Yeah. So today we're doing a deep dive into these recent market movements, pulling apart the signals and, frankly, the noise based on the sources you've shared.
Mm-hmm.
Our mission here is really to dissect the sentiment around the specific companies getting the most buzz in the briefings, figure out what's truly driving prices up or down, and maybe even hazard a guess at what it means for their stocks going forward.
And what's fascinating looking through these sources is just how clearly they show a market that's, well, it's not moving as one cohesive unit at all. It's a study in contrasts.
Right.
We're going to look at those most mentioned companies, connect the dots between, investor feeling and how their stocks are actually performing, see where the market thinks the growth is. That divergence really jumps out. The sources paint this picture. One even describes it as the market having cleaved into two very different Americas. That's quite a phrase.
It is.
On one side, you've got what they're calling the future, chips, cloud, the large language models, LLMs. That seems to be where all the excitement and a lot of the money is flowing.
And it's more than just a sector doing well. It feels like a fundamental reevaluation where the market's saying, look, intangible assets, scalable digital stuff, that's just superior now to the old physical world assets.
Digital gold rush.
Kind of, yeah. And the sentiment there is overwhelmingly positive. I mean, look at Nvidia. It's the absolute poster child, or poster chip maybe, for this boom.
Hey.
Market cap nudging, $4 trillion? And the sources mention its quarterly revenue line is longer than a CVS receipt.
Okay, so you need a scroll bar just to see their earnings. That paints a picture. Are they selling the future or just a really, really long receipt for it?
Well, the market certainly thinks it's the future. Nvidia is leading the charge. The sentiment, super bullish, it's all about their role in AI infrastructure, suggests continued upward pressure on the stock.
Okay.
Then there's Micron. They're a big DRAM player, right? Getting a nice lift because AI just eats up high bandwidth memory. And Broadcom. They just dropped a massive quarter, too. It reinforces that whole semiconductor AI infrastructure strength.
And it's not just the hardware makers feeling the love, is it? The software and services side seems hot, too.
Oh, absolutely. Take Palantir, up over 80% year to date. The briefings say it's benefiting from, get this, dystopian-sounding optimism.
Dystopian optimism.
God. But it suggests strong positive sentiment is directly translating into huge stock gains. Then there's Oracle. Larry Ellison became the world's second richest person for a bit there, thanks to a 32% jump in Oracle's stock.
Wow.
Yeah, fueled by their cloud and database stuff adapting to AI. And Meta Platforms, stock reaching new heights, lifted by Zuckerberg's big AI hiring push, forming that superintelligence unit. For all of these players, the sentiment is clearly bullish. They're doubling down on AI, and the market expects continued growth, implying, sustained upward pressure on those stocks.
Okay, but here's where it gets really interesting for me. While all this AI stuff is, reaching for the stars, what's happening back down on Earth, the other side of this split, the forgotten fundamentals, as the sources call it, that picture looks, pretty bleak.
It really does. On Main Street, it's mostly markdowns and cutbacks. The reports show Target, for instance, slashed its outlook. That signals consumers are pulling back.
I saw that. Home
Depot's traffic, described as stuck in neutral. So, challenges in home improvement continue. And broader sentiment. McKinsey found 43% of Americans say they're cutting back.
43%. That's significant.
It is. Plus, inflation is still too sticky for comfort, and then you've got tariffs hiking prices on durable goods. It all adds up to a really tough environment for retail, for physical goods companies. The outlook implies continued downward pressure, frankly, on their performance and stocks.
So it's not just slow growth, it's actual headwinds, rising costs, nervous shoppers.
Exactly. Even a giant like Amazon, while obviously a tech leader, faces these same issues in its physical operations. Their prices are reportedly rising faster than inflation because of those tariffs. And operationally, they have over 1 million robots, which is amazing, but the average number of human employees per facility in 2024, lowest in 16 years.
Wow.
And their own CEO, Andy Jassy, noted AI will probably lead to a smaller workforce eventually. Now, investors might see that as efficiency, but it definitely plays into this narrative of machines winning over humans in the physical economy.
Really sounds like that market revelation quote, where the machines are winning and Main Street isn't even like in the tournament. So is the prevailing sentiment just that capital should keep pouring into AI, even if it leaves traditional sectors behind?
That seems to be the overwhelming message from the market right now. The preference is crystal clear. AI is the only growth narrative worth trading. The S&P's biggest gains, coming from a tiny handful of AI names. So yes, the sentiment suggests capital will keep flowing that way, keeping upward pressure on those stocks, while the Main Street companies, well, they'll likely keep struggling or stagnating. Downward pressure seems more likely there.
That's a really stark divide. But okay, it's not always just AI boom or Main Street bust, right?
Yeah.
Some big companies seem to be dealing with a mix of unique issues, headwinds, and tailwinds. What about some of those high-profile names?
That's a really important point. It gets much more complex with specific companies. Take Tesla. Highly volatile situation there, according to the sources.
Always seems to be something going on with Tesla.
Right. So, headwinds. Reports highlight this renewed public spat between Elon Musk and Donald Trump. Musk apparently called the Trump administration's tax bill utterly insane and destructive, even threatened a new political party.
Okay.
And Trump apparently responded by suggesting a department Musk used to run should investigate subsidies given to Musk's companies. This feud, the briefings say, made Tesla's stock plunge 14% on June 5th, and it was under pressure again when they started fighting again.
Wow, so politics directly hitting the stock price.
Directly. Plus, the company is expected to report soft second quarter delivery numbers, so fundamental concerns too.
That's a lot of negative noise. It feels like the political drama almost overshadows the actual car business for a moment there.
It absolutely can. But here's the tailwind side. Despite those delivery worries, some investors are reportedly just shrugging it off. They're focusing on Tesla's AI future, the robotaxi launch.
Potential?
Exactly. And there was even this quirky note in one source about a Tesla car apparently having just delivered itself to a customer.
Okay, that's nice.
So the sentiment for Tesla, incredibly mixed, volatile. The sources suggest this feud's development could end up being the most important factor for the stock, which implies, potential downward pressure if it escalates, even with that underlying AI buzz.
Fascinating. What about Moderna? They seem to be caught between science and politics, too.
Yeah, another complex one. On the plus side, their mRNA seasonal flu vaccine, promising late-stage trial results. The CEO, Stefan Bancel, is looking at a combo flu and COVID shot. Higher efficacy in older adults. That's big news.
Sounds like a clear scientific win. Should be great for sentiment, right?
Yeah.
But you mentioned politics.
Right. Here's the counterbalance. U.S. vaccine policy is reportedly going through a major overhaul under HHS Secretary Robert F. Kennedy Jr.
Ah.
This includes, according to the sources, defunding Gavi, that's the Global Alliance for Child Vaccination, firing the CDC's Vaccine Advisory Committee and replacing them with skeptics. Some described as publicly anti-vax or pushing debunked claims.
Oh boy.
This new committee quickly voted to ban thimerosal, a flu shot preservative, despite loads of safety data. And they plan to reconsider the entire childhood vaccine schedule. That could strip shots of CDC approval, insurance coverage.
That sounds potentially devastating for vaccine makers.
It could be. And specifically for Moderna, HHS canceled a $590 million contract for a bird flu vaccine, calling the mRNA tech under-tested.
So amazing science, but facing huge policy hurdles. It sounds like the positive sentiment from the clinical trials is just getting swamped by these regulatory and political headwinds for Moderna.
That's exactly the picture painted. It creates significant uncertainty, suggesting potential downward pressure on future revenue and the stock, regardless of the science.
Okay, switching gears slightly. What about traditional industries trying to adapt, like Ford and the EV challenge?
That's another angle here. Ford's CEO was quoted saying China's EV dominance is the most humbling thing, and that Chinese cars are far superior.
Wow, that's candid.
Very candid. It highlights just how tough the competition is for legacy automakers in the EV space, suggests headwinds for Ford in that crucial growth area. The sentiment there is one of acknowledging a steep uphill battle, likely dampening future stock expectations.
Okay. Any bright spots outside of pure AI?
Well, interestingly, Comcast's Peacock streaming service seems to be showing some surprising strength, mostly thanks to Love Island USA, believe it or not.
Love Island.
Yeah. The sources say it's changing how streamers view TV, giving Peacock this rare daily hook with episodes almost every night. The companion app is huge on the App Store. Their TikTok followers exploded.
Huh. So niche content driving real engagement.
Exactly. It suggests really positive sentiment for Peacock's strategy. Could be a nice tailwind for Comcast's streaming business, pushing sentiment upward for that segment.
Interesting. And what about Apple? They always seem to have something cooking.
Always. Apple's keeping relevant through diverse innovations. Reports say they're working on XR devices, maybe a Meta Ray-Ban competitor. And crucially, they're apparently considering using AI startups like Anthropic and OpenAI to finally update Siri.
Ah, bringing Siri into the modern AI era.
Seems like it. Plus, their F1 movie with Brad Pitt was apparently their first theatrical hit. Good box office, lots of sponsorship money. So these things suggest positive undercurrents, diverse efforts keeping them strong. Sentiment seems stable to upward for Apple.
Okay, so beyond these big individual stories, you mentioned this uh, unprofitable rally. That sounds a bit worrying. What's going on there?
Yeah, it's a fascinating trend highlighted in the briefings. We looked at the data, and basically, unprofitable companies in the Russell 3000 index rallied, on average, 36% since early April. That's way more than low price-to-earnings stocks, which were up maybe 16%.
36% for unprofitable companies.
Yep. Specific examples like Enlight, Aiva Tech, Ouster, all up 200% or more.
Wow. So money isn't just chasing solid returns, it's chasing anything that moves up. What's driving that kind of, well, seemingly irrational behavior?
The sources suggest it's largely two things: unwinding short interest. So people closing out bets against these stocks, and retail speculators basically buying the dip, hoping for a quick buck.
We saw some of that post-COVID, didn't we?
We did. But the sources add a strong note of caution. They say it may not last nearly as long this time, and there are some pretty big warning signs flashing. Well, analysts at Kailash Concepts point out that something like $16 trillion worth of U.S. companies now trade at more than 10 times their sales. That multiple is described as almost impossible to justify.
10 times sales, not earnings.
Sales, and as a percentage of the whole market, that's apparently similar to the tech bubble peak 25 years ago.
Right.
Plus, the Shiller PE ratio, which looks at long-term earnings, is pricier than it's been like 96% of the time historically.
Yikes.
Yeah. And Luthold Group notes that this whole bad news is good news idea, where weak economic data makes people hope for rate cuts, which boost stocks. That's apparently pretty common in a late-stage bull market, often popping up alongside pre-recessionary signals.
Okay, those are some serious red flags. So while these speculative stocks are flying high right now, the expert sentiment is basically saying this looks bubbly, high risk, maybe unsustainable. It sounds almost like a belief system driving it, not traditional investing.
It does make you wonder how long belief alone can prop up those kinds of valuations. And these big trends, the AI boom, the Main Street struggle, this speculative rally they're translating into some wild swings for individual stocks this past quarter, it gives you the full picture.
Yeah. Who are the big movers?
Well, Coinbase Global, the crypto exchange, was a huge gainer, up over 106% in the quarter, clearly riding that crypto wave. NRG Energy also did well, up 72%.
Okay, and on the downside?
United Health Group took a big hit, fell 41%. And green energy stocks like Enphase down 37%. The reports mention renewable stocks are sliding because the Senate is looking at rolling back some tax credits. So negative sentiment shift potentially driven by policy changes again.
Policy risk seems to be a recurring theme.
It really does. And then there's Wolfspeed, a semiconductor supplier. Talk about volatility. Shares basically doubled pre-market after they filed for Chapter 11 bankruptcy, but that was after plunging 98% earlier this year.
Bankruptcy makes the stock double. That's counterintuitive.
This extremely volatile situation shows how the market reacts to drastic news, but clearly the overwhelming pressure was downward before that filing.
So we've got speculation, clear winners and losers, policy risks everywhere. But looking beyond the immediate noise, where's the serious long-term money betting on the next big thing?
That's such a critical question to ask amidst all this, because while we track the day-to-day, you have to see where the really big strategic bets are being placed for the future of power and infrastructure.
Right.
Look at Google, for example. They're making this massive long-term bet on unproven nuclear fusion technology, planning to buy 200 megawatts from a company called Commonwealth Fusion Systems by the early 2030s.
Nuclear fusion. That's still pretty sci-fi for most people.
It is. But it follows Microsoft making a similar deal earlier to buy fusion power from Helion. These are huge, forward-looking commitments. What does it tell you?
They expect to need a ton of power.
Exactly, for all those future AI data centers, for EVs. It's a clear signal of where long-term tech investment sentiment is really headed, underneath all the current speculative froth we've discussed. It shows that despite the volatility, there's still a serious chase for fundamental, game-changing innovation.
Okay, so wrapping this up.
Yeah.
What does this all mean for you listening in? It seems really clear. We're in a market that's heavily tilted towards this narrative of uh, frothy futurism over the forgotten fundamentals. We're seeing, machines winning, Main Street struggling, and these really unique, complex stories playing out for big names like Tesla and Moderna. Understanding those specific pressures and the broader speculative mood feels more crucial than ever.
And it really raises that key question, doesn't it? In a market where pure speculation can send unprofitable companies soaring while solid fundamental sectors struggle, how do you tell the difference between genuine, groundbreaking innovation and just unsustainable hype? It's a reminder, I think, that not all rallies are built the same. Understanding the why behind the numbers, like we've tried to unpack from your sources today, is probably more critical than ever for making sense of it all.
Well put. Thank you for joining us on this deep dive into the market's current complexities. We really hope this gave you a bit of a shortcut to being well-informed and maybe sparked a few aha moments.
Like so too.
Until next time, keep exploring, keep questioning, and keep learning. This has been Market AM Sentiment.